everyone, and welcome to the Economic Impact. Today, we are November 6, 2023, and as usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Hi, Denis.
Once again, another very, very volatile month. And if we look at, what happened, give us a little bit the trend of the last few days or weeks.
Well, you put the word on it, Denis, the finger on it. Volatility is the name of the game. After only 3 days in November, it's been a great month so far. After 3 days for global equities, you're up 4%, almost 3.6%. But as you say, the quarter's flat. So some days you'll make 10% in certain sectors. Some other days you'll lose. And that has to do with the environment in which we're in and, higher interest rates. We have yet to assess the full impact of previous rate hikes. All this brings into questions and sets the table for higher volatility.
Yeah, in the month we had a peak in interest rate, but they fall quite a lot in the last few days.
Yeah, so the good performance of equity market reflects the fact that 10-year Treasury yields in the U.S., on which equity markets are normally priced, are down significantly in 3 days. They're down 50 basis points in the above.
That's a lot.
But we're still at high levels.
Yes,
so again,
we are.
I understand that earnings did well in the third quarter, better than anticipated. Interest rates are now down because maybe the Fed is finished with its tightening cycle. But Denis, the uncertainty about growth in the economy and earnings is still very much present for the next few quarters.
Yeah, and we're seeing a discrepancy between manufacturing and non-manufacturing, in fact.
Well, what we're seeing is the manufacturing sector is already in contraction. That reflects the fact that global trade flows are actually contracting by 4%, which is seldom observed outside recessions. But what we're noticing now, Denis, is that after a very strong third quarter, even the service sector, the red line on that slide, is showing anemic growth. So it's not because third quarter was very strong in the U.S. and earnings were great that we're not going to feel the impact of previous interest rate hikes on the economy. And I think we're starting to see this.
Yeah, but okay, now we're seeing non-manufacturing and manufacturing slowing down. The employment, we had a number last week. How does it look? Is it, in parallel?
It's a good point. If production slows down historically, employment follows. And what we saw for the month of October is, notwithstanding the impact of the auto strike in the U.S., was a decreased willingness of employers to add to their headcounts. And that reflects what you're seeing here in slowdown in manufacturing or economic activity. That's, it goes before employment. Employment is probably the next shoe to drop.
Okay. But at the same time, you've been telling us that not all the impact of the rate hikes are already in the economy. And I think you have a very interesting slide on that.
Well, that's it. So before you decide on whether it's a soft landing or a hard landing for the economy, then you have to take into account that so far, given the transmission lags of monetary policy, we've felt the impact of 60% of previous rate hikes. There's another 40% to come. So basically, even if the central banks stop raising interest rates, there's still a 40% coming on the pipeline. So basically, what it means from a Canadian standpoint is even though the policy rate's at 5%, the economy is operating as if it was at 3.75, and we're going to feel another impact in the quarters ahead. That's why you have to be prudent in assessing the outlook.
Then it's not a good time to get excited. There's more bad news to come.
There's probably a little bit more bad news than what the market currently anticipates, particularly for earnings. I think interest rates will go down, Denis, but the challenge will be earnings.
Yeah, but at the same time, we have a kind of a sticky inflation, somewhere.
Yes, and that's why the central banks are not promising to cut interest rates anytime soon. If we take the example for Canada, for example, I'm really happy that compared to last month, inflation, the blue line, is actually down a little bit from last time we saw each other, which was at 4%. Yeah, so at least it's moving in the right direction, but very slowly.
Yeah, but at the same time, there's one component which is pretty high.
The shelter
which is
line.
a shelter.
Yeah, it's 28% of the CPI. And what you're noticing on this slide, and if you look at the CPI excluding shelter, it's below 3%. But the shelter component is keeping inflation higher than it would otherwise be the case in a normal cycle.
And that's the one that's going to be very, very difficult in the economic context that we are in right now to bring it down.
Because it's not a normal cycle. And if you want to look at, the best way to illustrate this is the fact that population in Canada is growing at a record pace. And the first 10 months of the year, we're up 880,000 people. And that's, based on the most recent month, which is the month of October. Denis, we're
Yeah,
going
but
to
I'll stop you. We're okay now because, the Fed just announced that we're going to have 500,000 people, not 800.
They want to reduce
They
want to reduce their immigration quota or not raise them. But that's a story for 2025 and beyond. In the meantime, we still have to cope with the fact that the population will grow 1 million this year, which for the working age population will be a new record, and that puts pressure on anything related to housing, which means that the Bank of Canada cannot cut rates quickly because of the shelter component.
Or the Bank of Canada will accept a 3% instead of a 2%.
That's
because of the shelter component.
It's an interesting assumption, and we'll see this in the coming months, coming quarters. It's a reality for many central banks, but even more so for Canada given the surge in population.
But at the same time, when we look at affordability, it's not good.
No, and I think that's what will depress consumption in the months ahead, right? If you look at the home affordability in Vancouver, Toronto, Victoria, only to name those cities, it's actually worse than the 1980s when interest rates were at 20%. So that's the challenge for the Bank of Canada. What do you want interest rates to do to fight against the population surge? And again, what you're suggesting that maybe they'll have to tolerate slightly higher inflation because the shelter component will remain sticky. Again, this is unprecedented.
Yeah, that means that we're going to need unprecedented action from government to keep that level not going higher or even at least stabilize and if it's possible going down. But it's very, very tough to see that in the, very close.
We need more supply for housing, which means more capital, or we want to reduce the immigration targets as soon as next year, and that will be a big decision from Ottawa's standpoint.
Well, you opened the door. Talking about capital, I think we have a problem in Canada. And you mentioned that in the past, but, it's even worse and worse right now than it used to be.
Well, it's not helping, Denis, and I know there's a debate about pension funds in Canada currently, and the reality is not all pension funds have a mandate or a mission to invest in Canada. And the latest data suggests that their willingness to get exposure to the domestic market continues to decline. It's not that they're not investing in Canada, but as a share of their total assets, these pension funds are not so exposed to the domestic economy. And maybe that's a question we need to raise at the political level is should we change the missions to allow more capital to stay in our country?
Or we have to prove them to invest in Canada makes sense for them. Then we need a really good environment for that.
Or deploy policy that makes Canada even more attractive. That's also a good point. But clearly we need to address this lack of capital coming to our country.
Well, thank you, Stéfane, and thank you for being with us. We'll see you next month, early December. Thank you and have a good day.